This video will demonstrate how the fair market value is determined for real estate properties. This price adjustment mechanism, which is common to all markets, links each seller with a buyer so that all inventory that is available for sale can be sold regardless of market trends. With real estate, at any given point in time, the vast majority of properties are actually not for sale, and as such they are not on the market. The only units that are on the market are the relatively small group that is listed for sale. The only price that is relevant in determining the fair market value is the price at which the latest buyer has agreed to purchase the property from the seller. This is because an asset is only worth what others are willing to pay for it at that moment in time. The latest average transaction price is usually broadcast to all buyers, all sellers, and also to the masses who are not actively buying or selling. When there are more buyers than sellers, this results in upward pressure on the transaction prices. When there are more sellers than buyers, this results in downward pressure on the transaction prices. Market prices are always determined by these two groups, that is, the buyers and sellers. Most observers tend to overestimate how large these groups are. In certain circumstances, sudden price movements can very quickly trigger unexpected behavior in the vast majority who were previously not actively involved in buying and selling. When large clusters of people from the vast majority decide to react to price triggers, they often rush into the market, inundating the normally small groups of buyers and sellers. The market then becomes highly irrational, and the new participants exhibit conformist or herd behavior, sometimes referred to by economists as animal spirits. During a bull market, this results in large numbers of panicked buyers, very few sellers, and rapid price increases as everyone seeks easy profits. During a bear market, this results in large numbers of panicked sellers, very few buyers, and rapid price decreases as everyone seeks to avoid losses. It should be noted that the catalyst which sparks the change in direction of prices from upward to downward or vice versa can be incredibly trivial. The price determination mechanism can be both fragile and frivolous, as it only takes one individual unexpected transaction to cause this kind of massive shift. At an unpredictable moment in time, as soon as the price reaches an unbearable limit, the balance of buyers and sellers will tip, and this will reverse the direction of prices. The longer the prices have been rapidly moving in any given direction, the greater the probability that the change in direction will elicit a panicked response by clusters of people from the masses who are normally uninvolved in buying or selling. Occasionally, excessive levels of property speculation can drive prices so unsustainably high that real estate investments become extremely risky, and this is referred to as a housing bubble. In order to help mitigate against potential swings in home prices, one helpful rule of thumb is to keep your total housing costs less than 30% of your gross household income, and to keep your total debt costs less than 40% of your gross household income. Due to the sensitive nature and high level of risk involved in real estate investments, please consult a licensed financial advisor and local real estate professional for more guidance that is specific to your situation.